Hi there, welcome to Kneppy Invest. The company I want to talk about today, Cleanspace Respirators, saw their share price fall 55% in one day. So a bit of a shock to Cleanspace shareholders at the time. Now, I haven't been following this company closely because I did believe it was overvalued and they had a lot of tailwinds because they really did benefit from COVID-19. And I think the market was really overrating or overvaluing the company based off that. And even when they released their half-yearly results about a month ago, management were hinting that sales were going to be lower in the second half. And the market didn't like the management hinting that, and we did see a bit of sell-off in the share price. But I don't think the market expected the numbers that Cleanspace gave us when they released a trading update on the 30th of March, and that is what caused the share price to drop 55% in one day. Now, when this happens, I do get interested in a company because this can lead to an opportunity to buy into a growing company at good prices. So I think there's always a time and a price to buy a company. Every single company on the ASX, every single company on the NASDAQ, now Dow Jones, S&P, every single company in the world, there is a time and a price to buy. And what we have to figure out, is this the time and is this the price to buy Cleanspace? Now, just over a month ago, I did do a little snippet on slide on Cleanspace in one of my videos. I think it was called The Villains of Reporting Season. And the reason I included Cleanspace was because the share price dropped 21% in a few trading days after they released their half-yearly numbers. And the whole reason the share price fell was because management said they expected second half numbers will be lower than first half numbers. Now, at that point in time, the market cap of the company was 447 million. So I want you to just remember that number, 447 million. Revenue and operating cash flow for the half year looked really good. A revenue of 40 million, operational cash flow positive to 21 million. But I think the market was anticipating, just like the management suggested, that the second half of the financial year was going to be much worse than the first half. And we saw that with the share price continuing after this sell-off when they released their half-yearly. So this is the chart in about 3 weeks after they released their half-yearly, and the sell-off in Cleanspace continued. So really, when you saw that sort of market reaction to results, you should have sold off on the first few trading days after then. So you could have sold out of Cleanspace at around $6. You might have lost a little bit of money, but that would have mean you would have maintained a bit of your capital because the share price just kept on dropping. In fact, just the day before they released this trading update, the share price was around $4.50. So the market was saying sell. Sometimes you need to listen to what the market is saying, and in this instance, it was definitely saying sell Cleanspace. So even though the market was saying sell Cleanspace, there were fundamentalists out there. So fundamentalists are people who just look at financial numbers and determine whether a company is a buy or hold or sell, that sort of thing. And all I did was go through some articles in the past, and a lot of these articles just looked at the financial numbers from the half year and were thinking this was a good company to buy. So there's an article from Simply Wall Street released on the 25th of March, and they mentioned how the share price was down 36%. But if you looked at the sound financials, might cause you to think again. Now, to be fair with Simply Wall Street, they did mention elsewhere on the website there were quite a few red flags when it came to Cleanspace. So I really want to be fair to Simply Wall Street. This little snippet is not the whole story. They did mention a lot of red flags. Now, I went to Hot Copper, and on the day they released the half-yearlies, on the 25th of February, there was a poster who looked at those numbers and suggested if you add a little bit of a premium to the Cleanspace share price, you could easily see the market cap valued at between $700 and $800 million. So again, just keep that in mind. Just remember those numbers when we look at the current market cap. Now, I do like to read Motley Fool, all the articles that pop up there. I do, on occasion, get some ideas. And on the 7th of March, they released an article called, "Are these small cap ASX shares could be ones to watch in 2021. And all they were doing with Cleanspace was looking at the half-yearly numbers and completely ignoring some other stuff. So actually they did mention it was also 25% and 72.6% higher respectively than management's forecast, but they completely ignored that management were forecasting the second half year numbers to be lower than the first half. So sometimes fundamentalists, particularly those who just look at the past numbers, don't actually understand that the market is pricing the future of the company, and that's what the market was doing. It was expecting the future to be much lower, the second half of the year to be lower than the first half year, and that's why the share price was going lower. Now, even though the market was expecting lower numbers in the second half of the financial year, because that's what management was expecting, and really, if you just think about it, with COVID-19 coming to an end slowly, you would expect Cleanspace products to be in less demand. So there should have been expectations around that, but I think what came as a surprise to the market and why the share price fell by 55% was the dramatic nature in the lower sales for the current quarter. So in the trading update, Cleanspace gave out the sales numbers for the third quarter of financial year, and it was approximately $7 million. Now, in isolation, you don't really have anything to compare, but you need to know the numbers or the sales in the previous half year. So the sales in the previous half year were 39 million. So a significant low amount of sales in this quarter. In fact, even if they double sales in the next quarter, we're still looking at sales going down almost 50%. They blamed a sudden shift in North American healthcare procurement, and they were still confident, or are still confident, that the business will return to historical growth rates in the medium term. I'm not sure what medium term is. So there's still potential headwinds maybe in the short term. And of course, they gave no guidance for the second half of the financial year 21. But a lot of companies are doing it. That means nothing. And this is the market reaction to this news. So we already know the share price is down 55%, which equates to share price decreasing by $2.45. So that decrease in share price is now greater than the current share price, which at the close of trading on the 30th of March was $1.98. I've just had a look at the current trading because I'm really recording this at 11 a.m. Eastern Standard Time. So that's 12 p.m. or midday on Eastern Daylight Time. And share price has been hovering around $1.90 or so. So significantly lower share price right now. The market cap is significantly lower. I'll get into that in the next slide or two. So the market is not liking this story. But there is always a but. When I see this sort of price action on negative news, I do know the market overreacts and there is a potential buy here. And I just have to figure out for myself, same with you, whether this is opening up an opportunity to buy into a growth company. So I decided just to look at some updated stats and financials of the company because we've seen a dramatic shift in some of these numbers in one trading day. So based off the share price, $1.98 and shares on issue 77 million. That means the market cap is 153 million. So if you had all those other market cap in previous slides, remember the market cap when they released the half yearly was around about 450 million, and they had that one post from Hot Copper saying a good value of this company will be 700 to 800 million. So you can see the valuation of Cleanspace is significantly lower right now than that. Now, the other really interesting thing about Cleanspace is they have a very healthy balance sheet. They actually have net cash of $40 million. So something like $44 million, not a lot of debt, which means their enterprise value is 113 million. So that's another reason this company is a potential good value play, simply because of the amount of cash they have on their balance sheet. So the question is, does this give us an opportunity to buy into a growth company at a good value? So Cleanspace is a growth company. So even though they've gone through this short-term blip, they were growing pre-COVID-19. So the first question I have to ask, is this a temporary short-term issue or a serious structural long-term one? And I think that's a very a very good question to ask, because you want to know, is this just a little blip? And management is suggesting this is just a little blip. But sometimes they can think it's a little blip, but it turns into a long-term structural issue. So that's something that's very important, because if it is a long-term structural issue, the valuation of this company actually could fall further. Now, the market cap was 500 million just over a month ago. Now it's nearer 100 million. So when you see that sort of depreciation in the market value of a company, that does lead to the question, is this good value now? It's definitely much better value than it was just a month ago. And the balance sheet is strong. This is what really attracts me to Cleanspace right now. Instead of having debt, they actually have a lot of cash in their balance sheet, $14 million of cash. And for a company with a market cap just above 100 million, say 150 million, that's a very attractive proposition. So I think this is a potential opportunity right now. I haven't made an acquisition of their shares just yet. I'm going to keep a close eye and just look at the share price, see if there's any more selling off, because you just don't know when some of those fund managers who bought this company way too high of a price will sell out. They'll just give up, set this company loose, probably sell at the low, that sort of thing. That could be when you're buying. When that selling drives off, that's when you buy into the company. So that's all I've got on this video of Cleanspace. Whether this company is a buy, hold, or sell, I'll leave that up to you. So maybe, or hopefully, I've inspired you to do more research on this company. Now, I haven't even mentioned what they do, but it should be sort of a giveaway based off the name of the company, what they do, the fact that they have been a beneficiary of COVID-19. And so I still would recommend doing more research on this company, particularly if you like this company and are thinking of buying into Cleanspace. So do more research, find a good time to buy, a good price to buy, and hopefully in 5 years' time, the share price of this company is significantly higher. I also think it's very important to know the sort of investor you are, what time frames you're looking at. So if you're looking at 5 to 10 year time frames, there is potential this company is going to be significantly higher valued than it is now. I'm just saying potential. I'm not saying it will be, because I'm not a financial advisor. And if you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. So that's all for this video. Have a good day. Bye.